Welcome to The New Next, a podcast that addresses current events and how they will impact the future. Co-hosted by the inquisitive public speaking champion, Mike McVeigh, and energy, economics, and technology expert, Matt Jensen. Join us as we explore all things energy, economic, tech, and political, and how they will affect our future. Podcasts typically grow by word of mouth. If you know anyone who would enjoy this content, sharing this in a message or by posting on social media would mean the world to us. Thanks for listening, and let's get started.
And a lot of the different cryptocurrencies have taken a huge hit over the past month or two. We've talked a little bit about Elon Musk buying Twitter and then not buying Twitter. And then, we privately, we sent some messages back and forth over this past couple of weeks, like with Tether taking the big hit that they've taken recently. Does this mean that people are going to be a little bit more hesitant to fund tech? Like, is tech funding going to be an issue moving forward, or is that a completely unrelated issue altogether?
We've talked a little bit about rising rates, and that when the interest rate at the Federal Reserve increases, that is typically meant to ratchet down the amount of capital in the system. And with that, they're trying to control inflation. And I believe specifically they think it's related to energy prices too. They're trying to control that. I don't think it's going to be, if that's the case, that's not going to work. But just because it's a shortage induced rather than over demand, essentially. But there's a lot of intangible effects to that. So when you can lower or essentially lend money at a low rate, if you're an institution or something, and then relend that out, then it has the opportunity to overheat. I think with all the money in the system during COVID and stuff like that, a lot of people, I would say, had a sky is falling mentality, and they're like, well, we need to get this money and we need to put it in the system and get it going and stuff like that. There was, I would say, a lot of tech funded that was very crappy, without to say that, like stuff that didn't have actual economics on it. And it was kind of like money was flowing freely, and capital allocators, their job is to allocate capital. So if they have that ability to loan it out and then go chase growth stocks, then they'll do that. Everybody and your mom essentially started a venture capital firm over the last couple of years.
That's what I missed out on.
Yeah. Me too, luckily, right? But you've seen this in the NASDAQ. I think the NASDAQ year to date is down 25% approximately.
Right.
And a lot of those were money losing stocks. You had the whole SPAC craze, which is basically funding blank check companies to go out and buy other companies, or do reverse mergers where you look at something that's basically a defunct listed stock and buy that and then fund it with capital and take a company public. So there was a lot of stuff that was run up big time because of access to cheap money and the ability for hedge funds and stuff like that to leverage up their portfolio to try to chase more returns and follow the trend, and stuff like Amazon, Netflix. I think Netflix is down like 80% or something.
Right.
Crypto, NFTs, like all this stuff where you're like, well, does this make sense at all as an investment? Is it ever going to make money? Because, your valuation in a public market is supposed to be what the market thinks discounted future cash flows are for the company. Like that's how you're supposed to value a stock. It went crazy. And I think a lot of people were like, this is wild. This is nuts. There was a lot of people involved in the industry too, that were like, this is wild. This is nuts. But we're going to party while we can and make it rain because we get a percentage off of whatever's committed to capital. But you're kind of in the situation where a lot of people bought high and they're going to sell low, or their companies are going to go bankrupt and their investors are never going to make any money out of it. So what we talk about tech funding today is there's so in VCs, like, or the investor world, you call it dry powder, and it's basically the amount of uncommitted capital that a fund has to invest in new funds. So if I'm like if I'm a entrepreneur that wants to get funding for my business, I'm going to want to go after someone that has a lot of dry powder, because I know that they'll be able to be more likely to deploy that capital.
Right.
And there's, I think, about 100 billion US VC dry powder right now. There's another 150 billion in private equity money that's been committed to VCs that could technically go in kind of like this tech funding cycle. But really, this has popped. The smart entrepreneurs that are reliant on money are raising it now at lower valuations.
Right.
You know, some of these companies were raising at 50 or 15 to 20 times revenue, and now they're raising at like 5 to 7, which is more in line with what you would normally have it. But it'll be interesting to see what happens over the next year. Like I personally think the crappy companies that don't have a business model that you can make free cash flow are going to go out of business. And generally, the smart people are telling their portfolio companies to be prudent with their capital and prepare for a long-term drying up, similar to the tech.com boom in the early 2000s, or bust. So we'll see. But I mean, rising rates sink all ships when irrational exuberance is abound.
Absolutely.
If you want to learn more, find us at thenewnextpodcast.com or matthewadjensen.com/podcast, where you can suggest a topic you would like us to cover. If you enjoyed what you heard, share the podcast, tell a friend about it, or rate us 5 stars. We appreciate you listening.